I want you to put the word out. We're back up. It's Wednesday, November 1st, 2023. This is Overtime. I'm your host, Chris Vecchio. Gentleman with the glasses is Ilya Spivak. That handsome gentleman on the other end is Dylan Radigan. Happy FOMC Day, guys. Ilya, you and I have been talking a little bit here on our Teams Messenger, and you and I have very divergent interpretations of what the Fed did today.
Yes. I'm very happy with this. I wanted to see the dollar sell off on this. It has. That's working. I want to see how stocks close here, because if they close even just a little bit lower, then my rotation thesis will get a little bit more confirmation. This is great. The Fed has done exactly what I wrote yesterday that they were going to do, which is really very encouraging for suggesting my finger is on the pulse.
This feels like a black and blue dress or white and gold dress moment. We're going to have to go through why you and I have different opinions on this. But Dylan, it was a good day here. S&P 500 now.
What's your opinion? What was your opinion?
Well, let's go through the market reaction first, and then I can explain why Ilya's wrong and I'm right.
Excuse me.
S&P 500 up by 1.04%, 4256 and a quarter. NASDAQ up by 1.79%, 14,750. Russell up by 0.35, 1674.3. Your Dow Jones up by 0.64%, 33,350 on the nose. Bonds rally across the curve, led by the long end. ZB is up by a full point, 21 ticks. UB up by 1.20 ticks here. Gold falls. Crude oil comes back in. The dollar is off. Okay, so why is there a point of disagreement between myself and my compadre here, Mr. Spivak? Well, first off, anytime that yields fall, stocks fall, and you see the dollar rally, I think people are predispositioned to think that it was a dovish meeting. I think it was more of a dovish hold from the Fed, because they mentioned for the first time in recent months that they've seen a tightening of not just credit conditions, but financial conditions as well. That's a clear hint that they believe that the rate hikes that they've been levying have been making their way through into the economy. There have been signs of that. We've seen that auto delinquencies, consumer credit card delinquencies have started to tick up in recent months. Housing market activity is obviously depressed thanks to those higher mortgage rates come through. And so the Fed is very much signaling to us, we are looking at the long and variable lag impact of monetary policy right now. We don't need to do more. It's just starting to filter its way through the economy. In fact, if you look at the CME FedWatch tool, hike odds for the December and the January meetings have fallen below 30% as of today. To me, this is a dovish interpretation of what the Fed had said. The Fed is clearly looking at warning signs. The markets like it because it means no more pain, no more tightening of the screws is coming. The screws are tight enough, as it were. Ilya, you saw the same thing I did. We're looking at the same dress, right? And yet you're saying that it's hawkish.
Yes, it is. And here's why. Nothing that you just said, all of which I agree with, is anything that the markets didn't know 2 weeks ago when Powell spoke at the Economic Club of New York and told them all of these things. So I completely agree with all of that assessment. Thing is, I don't think the markets got anything new in any of that part of it. The part that I think the markets did hear that they didn't like nearly as much, and that we are going to see show up here, maybe, into the close. We know that the markets like to read the Fed at face value for about 24 hours, then digest and think about what it is that they were told. So we'll see how this goes. But the bit about when rate cuts are coming is, I maintain, the most important part of this story. The market has been convinced that the Fed is done raising rates for months now. If we look at what's been going on with the 2-year yield, we've been in higher for longer mode in the most overt way, at least since the September FOMC. That's that big divergence between the 2-year yield and the 10-year yield. So that much isn't new. We know that. The question is, when are the cuts coming? When is the release valve going to arrive? And right now, the markets were told by the Fed, we're not even thinking about it. The labor market is still too tight. We're going to hold and hold and hold and hold. That's the hawkish part that's different and the part that clashes with market expectations. Now, of course, the Fed was never going to not say that. Of course they were.
They have to.
They have to. But that isn't what the markets want to hear. What they want to hear is, yes, investors, we are going to give you the obligatory cut no later than the middle of next year. Don't you worry, help is on the way. That is not what he told them.
But the Fed can't say that right now because we're still in this turbulent period for inflation where you probably see a little bit of a dip in October. You're going to get a rebound back in November, December, and inflation doesn't really begin to roll over until the early months of 2024. It's by that March SEP, that March Fed meeting, when the Fed can actually begin to signal that we think that inflation is done and dusted, and they can begin to lay the groundwork for the rate cut. Doing so now, after what we've seen was a policy error, a self-imposed policy error, by the way, saying that inflation was transitory and sticking to that view for far too long in 2021, they must insist, for the sake of their credibility, that they could raise rates again, that they have to keep rates tight from here, that they have to stay vigilant in their efforts to defeat inflation, lest they throw in the towel now. And look, I mean, the Fed's economists can model this out just the way that we can. If inflation were to evolve at a 0.1, 0.2, 0.3% month-over-month run rate here for the next few months, you will see a rise in headline inflation again through the end of the year, plain and simple. So for them to take the tack that we can start talking about rate cuts, and then the immediate reports that we see hereafter over the next 2 to 3 months produce a bump in inflation, they're just going to have egg on their face and the market's going to doubt their credibility. So there's no world in which I would expect Powell or any of these Fed officials to come out here before early 2024 and even discuss, hint that cuts are coming on the horizon, even if the market knows, like, you're playing this game, we know that you're playing this game, you know that we know we're playing this game, so let's just all keep dancing and pretending like, you guys are really serious at being hawkish. I think the hawkish impulse here is done and dusted. There are no more rate hikes coming, plain and simple. Cuts will be back in the middle of 2024.
We knew that. I think there was a level of expectation in markets, and we can see it in the way that the odds for rate cuts have moved in the part of the curve for next year. We know that leading into this, the view relative to September's FOMC to now, so in that month, 6 weeks or so, what we got was this sense that 6 months out from now, 9 months out from now, the curve somewhat pulled in, whereas the higher for longer part, 2 years out, 1 year out, that part got steeper. And so that twisting of the curve, since the September FOMC told you, the markets as of that meeting already knew that rate hikes had already peaked. Hence the stasis in ZT, the 2-year bond, as well as the flip side of that, the 2-year yield. What they thought, though, was that the Fed might throw them a bone. Hence the twisting of the curve at the 6-month relief, the 7-month, something like this. They were waiting for the Fed to go, yeah, we think that there's enough in the system now to get us to where we need to go. And of course, we're data dependent. We'll see how it goes. What Powell said today pointedly was, we are still looking at this through the lens of, do we need to hike again and when?
They're saying that, but it's a bunch of nonsense. And the market took that in turn here today. These are the SR3 3-month SOFR futures. We can derive the estimated Fed funds rate, at least implied by the market, by taking what you see here on the y-axis in the right column, the right side of the screen here, and subtracting that from 100. We opened up, today's price was 94.815, which means you're looking at a 5.185% Fed funds rate by June. This is the M4 contract, so we're looking at the June expiry. We close at 94. Right now we're at 94.92, which means there's a 5.08% Fed funds rate implied through June 2024. Effectively, what that means is that the odds of a rate cut in June, if you move in 2.5 basis point, if each point is basically 2.5 basis points. So you're talking about odds of a June cut soared today by about 40%.
Mm-hmm.
The market is looking at this and telling us that the Fed may be paying lip service because they have to. They have to say the right things. But what will they actually do? They're going to fold, and they're going to fold by the middle of next year because the battle is almost over. One thing that Powell pointed out today was that inflation expectations, despite what you see in the one-off, U of Michigan report here or there, he thinks that inflation expectations are coming back in reasonably. Consumers are expecting the worst of this to be over. That's important for their inflation outlook. As long as inflation expectations are anchored, then you will ultimately see a Fed having the ability to back off because so much of inflation can be self-fulfilling. If you think inflation is going to be higher down the line, then you're more likely to spend money now before your dollars lose purchasing power. And that's going to create that, cost pull inflation up in the near term. Demand spikes, inflation runs higher, and then the Fed has to keep rates higher for longer thereafter. But Ilya, you yourself, and Dylan, I want to bring this to you as well to get you in on this conversation. You have been talking about how there could be a bounce in markets here. Mm-hmm. We were talking about this on Futures Power Hour. We spoke about this on Monday a little bit. We returned back into that consolidation that defined end of September, beginning of October. My heuristic is, do you leave a consolidation, only return into it? You're bound to go touch the other side. And so I'm bulled up here. I think the NASDAQ and the S&P have a ways to go right now in the short term. We could be looking at another 300 points or so here at NQ before we actually run into some resistance. Dylan, are you taking advantage of this volatility environment? Are you selling puts here in NASDAQ? Are you on board for a November rally to make up for the sins of October?
Well, first of all, I just want to say that I think this is a moot conversation. With all due respect. This conversation is moot. So I'm just calling moot on the whole thing, okay? The market told you they liked it. Full stop. Whether it's the adjustment and the probability of a rate cut next year, whether it's the value of risk on assets and equity indices, whether it's the perceived liabilities at the long end of the bond curve, we can all have our opinion, but your opinion is moot because the market told you, I like this. And what I'm interested in, because, and obviously Chris likes this. Okay. I like it too, by the way, but that's again. What do I?
It's working for me.
And sure, you
my
like
short,
it too.
my short dollar exposure.
Who doesn't like a little yield, a little dollar weakness, a little yield? These are all kind of semi-public positions, right? People want to see the bond go up. They want to see the yield come down. They want to see equities rise because everybody always likes to see equities rise, with obvious exceptions. But generally, people like to see rising equity prices. What's interesting to me is not the optimism, which, to answer your question directly, Chris, I share. I got more long than NASDAQ today. I wasn't able to get the fill that I wanted, so I didn't do it, but I'm looking to sell put spreads on that TLT to boost that long call position, which is obviously working because it's moving, whatever. But what do I know? I'm just another person doing things at the end of the day with a point of view.
Just a person doing things.
Just a person doing some things, okay? That's why the whole thing is moot. Okay, anyway, you ever see the Jesse Jackson? This is before everybody's time, but whatever. There was a great Saturday Night Live, it's like game show decades ago for when I wasn't when I wasn't the Alec Baldwin of financial punditry. As Chris likes to call me, but he would ask questions on the game show and be like, how much of whose face is on the $100 bill? And then, Chris or Ilya would go to answer and he'd say, and he wouldn't get to answer. He'd say, question is moot. No one's seen a $100 bill in 10 years because they don't got no money. It was a whole spiel. Anyway, it was funny. At least I made you guys smile. So my point is this whole discussion, rate cut, Fed, to go full Sosnoff, question is moot. Market likes it. Ilya doesn't like it. And
I do like it.
Like is the wrong word. Ilya thinks it implies a less beneficent rate structure than the market believed. The market interpreted
than the markets wanted to see.
I don't care what Chris thinks or Dylan thinks or Ilya thinks. I'm saying the market said, pretty good. Pretty good.
Yeah, no, I agree.
Sell them, flip them, dip them. Everybody gets a couple bucks. Go home, have a good time. That's great. You look at this and you're like, I don't know. And that's sort of the interesting piece from my perspective.
I look at this and I say this encourages rotation out of U.S. denominated assets. So while this is risk
You
on,
mean because it encourages more risk on positioning, so you can abandon the dollar, abandon U.S.
because
markets?
it's broadly risk on, so you can abandon the dollar. But more importantly, that the rate cuts are coming faster in Europe, say, than they're coming here, which means that risk capital should go there rather than stay here.
Which goes to your long European equities narrative from last week.
Exactly, and
Basically
also my long euro and my long Aussie dollar.
Euro,
right.
blah, blah, blah.
Right. So, I mean, I'm long risk here, and I am in particular long anti-dollar risk.
Okay. So here's my question for you, Chris, because Party Boy out in San Francisco here seems to think that this is a very good report, but his interpretation of the report is it's so good everybody's going to leave the big house to go party in the yard. They're going to go to Europe. They're going to go to Asia. They're going to go to South emerging markets, blah, blah, blah. And as a result, your optimism for U.S. assets will be betrayed by the ebullience of the risk-on crowd. I'm being hyperbolic. Marginally migrating away from all U.S. assets. I mean, my point is, Ilya, I could argue your assessment is more optimistic. You're saying it's so good, everybody's going to party in Europe.
They've been beaten down. And if everybody is going to hold hands and walk into a global recession that central banks have now engineered over the course of a year and a half, then you go to where risk is cheapest. And if yields have peaked everywhere at the same time, you go to where the medicine will be soonest to arrive. For now.
Which is European equities and Europe.
Which is Europe and which is to some extent emerging markets. To some extent.
I don't agree with that whatsoever.
Excellent.
Capital flows across country borders because of relative differences in real interest rates. Europe may be getting more rate cuts or getting rate cuts sooner than the United States, but in turn, that should depress their relative real interest rates, which means capital will still be attracted to the United States because we'll be maintaining not just higher nominal interest rates, but as inflation comes down, we'll be having relatively elevated real rates compared to our foreign counterparts for the foreseeable future.
I agree with that as well. Just
that's going to attract
3 months.
That's going to attract more money to our bond market. When you look at the earnings profiles of companies in the United States versus Europe, that's going to attract more money to our stock markets here. I think a Federal Reserve that maintains a relatively more hawkish stance compared to its counterparts is a good thing, but the Fed itself, compared to where it was a few months ago, is backing off. It's going to be a magnet for capital in the United States. As some may say, the U.S. is going to drink the world's milkshake here. The dollar is going to continue to do very well. Yes, the dollar came in a little bit today. But over the next 3 months, why on earth would you want to be chasing, the theory or the hope of potential rate cuts in Europe when you have a recession there and declining corporate earnings? When earnings
That's
here
exactly
in the U.S.
why you do it.
Well, earnings
That's
here in the U.S. have
exactly
turned
why you do it.
I don't think
because
that's a good
assets
reason.
there are cheap. Because in the
but they've been
US,
cheap for the past
stocks are
15
up double
years.
digits this
Bro,
year.
they've been cheap they'll be cheap. They're going to get cheaper. Everybody's
They're going to get cheaper.
They're going to get cheaper as a 2024 story. But as a 2023 story, we have 2 more months left.
Now
as a
you're
2023
now
story,
you're really a hippo dancing. So. Now you're really a ballet dancing hippo, if I must say.
I mean, I maintain, and as I've maintained for years and years and years and years at this point, that the U.S. dollar bottomed at some point in 2011, maybe even early. That the way is toward the U.S. surviving the deglobalization better than elsewhere, that this is good for U.S. assets, that this is good for the dollar. So everything Chris is saying, I agree with. I just don't think that tactically.
You just think that there's a little bit of a jam in the jumper for the next 2 months in Europe.
2-3 months or so, yes, because
there's more leverage in the snapback on the optimism of the Fed is for sure done, contingent.
Well, they're all done.
Right,
that's the whole thing.
They're
all done.
Yeah. Okay.
So, yeah. Ilya, the Euro Stocks 50 ETF is FEZ.
Mm-hmm.
Are you saying that you would go long
Morocco?
I don't know, but would you go long FEZ versus SPY here if you think there's going to be relative outperformance? You're saying both will go up, but you think that Europe is going to do relatively better. You'd rather be long FEZ than SPY here through the end of the year.
My vehicle is EZU. Which is the Eurozone the Eurozone ETF, and I'm already long.
All right, well, let's do it. I think we should all do it. I'll do it. I'll do that. I already bought the NASDAQ today. I'm long the TLT. I'm looking to short these TLT puts. I'll pick up your EZU, bud.
There it is.
I suppose diversification's good, but why bet on different horses when you know one's going to win the race?
Right. Your point, Chris, is like, what am I doing here? Like, you're making my life complicated. Like, I have the most liquid, most valuable indexes on earth that are set to run on the same exact piece of information. Why bother diddling around with?
I think the dollar is answering that question for us. I mean, as we speak.
Ilya, the Eurozone is a lot more FX sensitive. Their earnings are a lot more FX sensitive than U.S. companies. If the dollar's about to come off and the euro has a chance of rallying in the short term, that's going to be a headwind for EZU, will it not?
Again, I'll see you in 2024, and I'll agree with you. I just don't think it's happening now. All of your arguments make absolute perfect sense.
You're basically just saying there's more leverage. You're saying there's more leverage in the same news by being long euro/long euro equities.
Yes. And
Chris,
in the nearer term, in the actionable
splitting
term.
hairs. Why are you wasting my time?
In the actionable window, I would.
I don't know if EZU is going to rally. That's also part of the reason. Like, I don't know if I have any faith in European equities to stage a significant rally or as significant a rally as what we're going to see here in the United States. But
because they don't have Tesla, they don't have Nvidia, they don't have the hot potatoes. It's because, like, who are they kidding?
That's
they don't even have anything in the kitchen.
That's right.
Listen, they have Nova Nordisk.
Expensive now.
You have Nova Nordisk.
They have Airbus.
You have Airbus, but if you look at Caterpillar's earnings, what did they say? That their demand for, and obviously Caterpillar and Airbus aren't the same type of companies, but those are big capital expenditures.
Same scale.
What they have is a 10% underperformance to U.S. equities
okay. How about
over the course of this year.
How about some fiat? You want to buy some fiat stock?
Is that still a thing, or is it still
in my face? Chris laughs in my face. It's so provocative.
I think Fiat has sold like less than 500 cars in the United States in this calendar year.
Yeah, but Nissan is in that realm still, right? Nissan counts.
I mean, but Nissan, listen, we're going to get on a real sidecar here. But like, Nissan lost their mind with that whole 1,000% electric thing, only electric, 10 years ago, which wasn't a terrible idea, I guess, considering they were already kind of lost the race with Toyota and lost to Volkswagen and lost to everybody. They're like, listen, you might as well play the empty road. Anyway, didn't work. Fiat is a fantastic automotive company, I'll have you know, and it's a fine automobile. And
I enjoy them.
I highly recommend them, and I have no vested interest in that statement.
Yeah, the Fiat 300 is a lovely little car. It's a joy to drive, much better than the.
And they own Ferrari, and they own Ferrari people. Like, listen,
I
can get you coming and going.
That's a big thing. Ever since that F1 show on Netflix, everybody loves that.
Listen, all jokes aside, Ilya, Chris makes a great point, which is it's going to be good. The Fed's saying they're done. Markets are up, blah, blah, blah.
Yep.
Why bother? Because there's in addition to whatever additional marginal upside you perceive because of the currency, because of whatever, you're going into a shallower marketplace of less dynamic companies that you know less about. You're giving up a lot of potential.
Because I don't think all of those things matter in the nearer term. I think all of those things begin to matter more when the markets start to look much more at the fundamentals rather than relative valuation. And I think right now what matters is if everybody is going to turn away from tightening at the same time, there is a very serious disparity, and there needs to be catch-up. And that catch-up is going to favor... Catch-up. Of course there is.
Why does there need to be catch-up?
Because the help will come soonest, and capital goes clearly to where the stimulus is greatest. And what we're going to find out here is if everybody is having a recession, then the place that's going to get the first bit of medicine is going to look better. And the Eurozone is going to get the first bit of medicine here. No question.
U.S. growth isn't looking too hot for the fourth quarter. We got
Why not just buy the long bond? Sorry. Again,
I'm about to make that argument here, Dylan.
What do we do? I'm sorry, you're the host. You're the host.
I agree there.
It's the second time I've jumped you. Let the man do his job. I'm sorry.
No, I agree with that.
If you're thinking about growth in the United States right now, the Atlanta Fed GDP now, which was off for the third quarter, but again has been the most accurate regional Fed nowcasting tool. If you look at the New York Fed or the St. Louis Fed or any of the number of other ones over the course of the past year, it came in today at 1.2%. Now, granted, this is only a third of the way through the quarter. We don't take these seriously into the last 2 or 3 weeks leading into the actual GDP release, which will come at the end of January here. But if lower growth is around the corner for the fourth quarter, mind you, the Fed's estimate for overall growth this year is 2.3%. That means that we'll have an annualized run rate of 1.2%. That's weaker growth in the United States, but getting an idea that they need to cut rates sooner. Where are growth expectations imbued? At the long end of the curve. What are our long end bonds doing right now? Yields are coming off because it looks like growth conditions are weakening. This, to me, is a very important chart that's playing out right now. And it's ZB. It is that long bond. Because
and ZN, by the way, looks even better because it's already broken that line that you have set. They
have. But why is it such an important chart right now? If you go back to September 1st, we closed below our 1 month moving average, that blue squiggly line here on the screen. And ever since then, we have not been able to put a close back above it. In fact, the last time we touched it was here on October 12th, and we put in a bearish outside engulfing bar, which marked the relative high, leading to a new swing lower over the ensuing sessions. We didn't close through the 21 EMA today. But tomorrow, if we were to do so, if we were to scale that initial swing low on October 3rd, you then see support very plainly here, becomes resistance in recent sessions, and we get a close back above our 1 month moving average for the first time in over 2 months. It would be a veritable technical signal, not just one predicated on volume, on exhaustion, which, by the way, that call on a long enough time horizon now is holding up. We talked about this about a month ago for the first time with the TLT volumes exceeding all-time highs, the back-to-back weeks of 3 million contracts traded in ZB for the first time since the highs, the actual highs during the pandemic last week of March 2020, last week of February 2020, first week of March 2020. We would actually then have a clear signal that bonds have bottomed. ZB, you mentioned, Ilya, ZN here, very much on the horizon of looking like it's making a turn. You could look here through that turn. We do get that close through the 21 EMA. First time we've seen that since October 31st. That's good news. We weren't able to accomplish that back in the middle of October when we did it. And here ZF, even more bullishness closing back to the 21 EMA, although we saw that a few times back in the middle of October. I point this out because ZT, ZF, these are the ones that are much more sensitive to what the Fed's doing. ZT is about Fed hikes. ZF is about Fed cycles. We're both seeing here that this is a clear sign that not only are growth conditions weakening, inflation expectations are coming back in, but the Fed is done. It's dusted. The evidence for the bond market bottom is here. It's arriving. We're living through it right now. It's taken a month, but the evidence is now starting to compile more favorably on the technical side as well.
I would agree completely.
ZF is not the place I'm playing it, though. ZB still is where the volatility is at. So if you are a put seller, collect your premium at the long end of the curve. 58 IV rank, IV index of 17.2. Dylan, you'd prefer to do this through TLT. TLT is seeing very similar types of readings because, as you can imagine, it's the 20-year plus bond ETF. IV rank of 58 point now. If you're selling your puts, get up while they're good.
Spread and good to own a call at the money from a couple weeks ago.
It's been working out very nicely. I think you're going to be rewarded handsomely. Christmas may come early for you this year, or Hanukkah, or Kwanzaa, or if you don't celebrate anything, whatever. I'm like Irish, Italian, Jew, so I can do it all. It depends on the situation. I take the best of all. Ilya and I have that covered between us as well. I'm Irish, Italian, and he's a Russian Jew. So the three of us are just three peas in a pod here.
We're really all there. It is. I just add more of what was already here as a single.
Pretty much.
Yeah, just a little bit more from column A and B.
I'm trying to offer a serious interrogation here on a serious matter, which is the global financial markets. And my concern is why on earth, Ilya, I would not simply take whether it's Chris's futures bonds scenario.
Or you can do both.
And why bother with the additional aggravation of this European situation? My point is it only because of the dollar? Is there any reason it's not currency related?
So for me, I think what there is a relative rotation here where the markets into the end of the year collectively say, okay, they're done. The relief is coming. The big thing that has been the stone in our shoe is finally getting shaken out. Okay, the situation is bad, but it's not getting worse.
Okay, and we got all that. But therefore, why is that good for Europe? Why is that a
because the supply of bad news is more exhausted in Europe, because the recession is already very much underway there, because the situation is much worse over there. And so those assets are on discount relative to U.S. assets. And so what there is an opportunity to do here,
cheaper relative to expectations.
Yes. And so what there is here is an opportunity for that gap to close as the pain becomes more acute in the U.S., which has been more resilient up to here, and the Fed throwing in the towel and saying there's a lot more tightening still in the pipeline is telling us, okay, the pain is going to become more acute, not less acute in the U.S. over time, but it will probably not become very much more acute in Europe. And so what capital is going to do is it's going to say, okay, European assets.
What about the fact that Europe is
down?
What about the fact that Europe is like a, it's a. This is it is a very sleepy little town.
I agree completely. I just don't think that matters in the near term, because where capital wants to go, in my view here, of course, I could be wrong. And the moment the price action suggests that I am, I will change my mind on a dime as ever. We were having this conversation at the end of overtime last week, the three of us. Chris was bearish. We were bullish. Today, Chris is bullish because the facts have changed. And as a good trader does, what he's done is changed his mind to go to where the money making is. So
I changed my mind around 10:15 this morning. Thomas and I both got into NQ and ES positions. I think Anton came along for the ride as well. But you have to just look at the market as it is, right? And not what you want it to be. I point that out. I only say that, Ilya, because 12 of the past 15 years, the S&P 500 has outperformed European equities. This year, we're outperforming European equities a little bit more by about 3%. But if you've been looking at a long time, and we talk about there has to be a return back to some equilibrium. There's due for catch up.
I don't think it's necessarily equilibrium. I just think that there is a gap here. I mean, let's be clear. My most money-making proposition this year and last year and the year before that, and really most of the past decade, has been to be long the U.S. through various vehicles, mainly the dollar. So I'm with you. I'm with you for most of next year on this narrative. However, we have to trade the markets as they present themselves. And I think what presents itself now is very akin to what happened, let's say, well, let's give a dramatic example. March 15th, 2009. The world is in deep recession. Everything is falling apart. The world will remain in deep recession for the next year or so, and that's before we get a little respite, and then the Eurozone has a debt crisis, and off we go again. So that March is when stocks bottom. Now, why do they bottom? Is it because things have gotten better? No. It's because they're not going to get worse. Because that's the point where the Fed goes, all right, we're going to dump everything that there is to dump on this. That, I think, is the situation in Europe now. It's not the situation in the U.S. yet.
What about the Swiss franc? Now that I'm here in Italy, back home, so to speak, a lot of talk about the franc. In fact, there are there's many a Swiss gentleman and gentle lady, I'll have you know, who on any given day might be driving across the border to go grocery shopping and get gas in Italy, France for that matter, or Germany for that matter, or Austria, depending on where they are. Because it's so much cheaper to consume basic supplies in euro-denominated groceries, gasoline, whatever, daily sort of supplies. I think it was one of the news agencies, probably Bloomberg, was doing a bunch of coverage recently about the Swiss franc as the best performing currency, non-dollar. For those two reasons, I will ask you this, which is, would you be a franc buyer?
No, and not because of any reasonable consideration. I am just not a fan of trading the franc, period.
Due to liquidity.
Well, it's because the SNB is a crazy central bank that's actually a publicly traded corporation and doesn't behave as a monetary authority should. It has shown itself to be generally irresponsible with the way that it conducts monetary policy and with the way that it communicates to markets.
Sounds like
because, well, see February of 2015 if you want to.
Listen, we can all make citations, Cherry, but
if you want to get a sense. But for me, the SNB is a central bank that pays more attention to its balance sheet that it has to report to its shareholders than to what is the thing to do for a responsible monetary authority. Its incentives are, in my opinion, not anything I want to deal with. And so I actually forego the franc completely.
I will never trade the franc in a meaningful way for the rest of my days here because of what happened on September 6, 2011.
You guys really have some strong feelings. I didn't mean to bring up.
We have scars. We have deep scars.
I mean, my scars like just like a big trading loss. It's the worst trade I ever had. I was riding dollar Swiss short, euro Swiss short all summer long in 2011, and I was a new trader, and I was in FX. You get a lot of leverage, and so I was doing the most irresponsible thing possible. The second I had enough money in my account to add another position in, it's like, oh, I now have enough room for a little bit more, there's more margin here because of the gains. Added short more dollar Swiss, short more euro Swiss. At the time I was working the European shift. And so, I would get to my desk at like 4:20, 4:30 in the morning. I'd leave work around, like 1 o'clock.
At which point I would hand off to him and we would have these conversations because I work the Asia shift.
Dylan, I'm floating a $25,000 rolling winner at that point in time. In the span of a minute, it turns into a $15,000 margin call.
I can do way better than that, but I understand the pain.
40K gone in a minute.
Oh, sure. Yeah.
So I felt like I was getting disemboweled, right? You've all seen that scene in Silence of the Lambs where he's hanging up there.
Well, what about when you're plus 40 in 2 minutes? It goes both ways.
It does go both ways, but it's just I'd rather not trade, as Ilya says, the rationale for putting in the floor, for taking out the floor,
or the whole tasty
and for the way that it was communicated to take away the floor on a Thursday. Having said on Tuesday.
Of all days.
This is not, listen, I'm going to start defending Switzerland. You guys keep this up. Can we move to a new topic? We get it. I got it. Okay. It's okay. But I don't want to.
And this happens for some traders, right?
I like Swiss people. I like the Swiss government.
Oh, sure. Is wonderful.
I believe in defined currency. I think it's a little too much. Personally, I would rather see it come down. I don't think the Swiss people should be forced to pay so much for gasoline. They're fine people.
Bern is a wonderful city. Zurich's a wonderful
watches
city.
and excellent chocolates.
This is not.
Will not trade their currency. Not for me. And currencies right now, Dylan, currencies right now are really boring. Like, let's just be clear about this. If you go through the currencies right now. I
wouldn't even be talking about it if it wasn't for the Russian.
I'm just pointing this out generally speaking, right?
Great.
The tasty, well, forget the technical setups here, right? You think about the volatility profiles of these instruments right now. 6A, IV rank of 9.5, 6B, 7.5, C, 7.3, 6E, 6.5, and even 6J right now, 7.2. Yeah, there's been some big movements. These things are dead right now. If you're looking for volatility, head over to oil, IV rank north of 50. Head over to gold prices right now.
Now we're talking. Let's do it. Thank you.
That's IV rank of 37 still, which, we said this on Futures Power Hour today. We haven't discussed this since we last spoke on Monday, but I got consistent with what I said about getting out if we see a close below the 5 EMA. Yesterday, right before 5 p.m. Eastern time, I see that we're going to close below the 5 EMA, so I'm out of gold now officially, and I used the proceeds of that to roll into ES and NQ longs today. So it's all working out nicely today. I rode that from 1844 up to about 1992. I'll take the 148 points in my long gold position any day of the week. And also, I don't think that this gold thing is, the fact that you see yields go down today, the US dollar go down today, and gold still peels off, that's a red flag. That's not what you'd want to see out of gold prices.
I think gold could go down 10%, 5%. I think gold could move meaningfully, materially lower, more than
this is in line with what we've been saying too, that there's a geopolitical premium here that probably goes away similar to how it went away in the Ukraine thing, where the markets try to benchmark what's going on. While they're doing that, gold is elevated. Once they've benchmarked it and it hasn't gone worse than the benchmark, gold fizzles.
That is the key thing here. I brought this up the other day. It's worth repeating again for people who weren't listening to the conversation. If you look back at all of the recent major geopolitical conflicts, right? Talking about it could be the Russian invasion of Ukraine. It could be when Trump, greenlit the assassination of Soleimani. You could go to the initial incursion into the Donetsk region by Russia a few years ago, or what was it, MH-73, I believe, the plane that was shot down. Afghanistan invasion, first Gulf War, right?
Yada, yada, yada. I thought that plane just disappeared.
You're thinking about the Indian flight to Kuala Lumpur.
Sorry. There's one that was like
they had the remnants of the one that
this one was legitimately shot down.
That the Russians
not a Bermuda
shot down, and then they didn't let anybody come look at it.
I forgot. I remember that one. Yeah, that was crazy. That was unfortunate.
Very, very odd. But either way, the point is that when you look back at all these geopolitical conflicts, right? Gold tends to rally for 4 to 5 weeks, 4.5 weeks. And then, as Ilya says, it gets benchmarked. And the unfortunate part of markets, you could call it cold, you could call it inhumane, is it becomes background noise. You kind of just get used to it. It's like if you move to Florida for the first time, the humidity is going to bug the hell out of you. But after being there for a little while, you get used to the humidity. It's not the same. You don't complain about it every single day. And
all of a sudden, you got yourself a tuk-tuk driver. You're not complaining.
Right. And so that's how it is for markets here. We figure it out. Gold's rally around the Russian invasion of Ukraine lasted all of 2 weeks, and then it slowly peeled off after. Now, the situation's different. We were going into a Fed hike cycle. Inflation was rip-roaring at the time, and so the Fed was going to be really, really aggressive pushing up real rates. You could argue that real rates are coming down now. The dollar has reached a near-term peak. Whatever your rationale is, the table set a little bit differently. So I do think that the floor is higher here in gold prices, but in terms of the geopolitical risk premium, I think that may have hit its apex in the very short term. And for me, the technical influence is very clear. You get the gap higher out of the weekend of October 7th, October 8th. You ride the 5 EMA, the 1 week movage average, all the way up until yesterday. That was the defining characteristic of the rally over the past 3 to 4 weeks. And now it's been broken. And so if you were trading this on the geopolitical risk premium, you got a clear sign here that maybe this bubble has been pricked. And so for me, I'm out. It was a good trade. Moving on. Now long ES, now long NQ. We'll see what happens.
Would you sell call verticals or buy puts? Or
no,
be short a container?
I would rather sell puts that are out of the money than look to sell calls, because historically, gold vol and gold price movement tend to be positively correlated over long enough time horizons. People don't panic buy stocks, but they will panic buy gold. And so if you sell a call and let's say that Iran decides to get involved in this conflict, gold is going to shoot up and vol is going to expand, and you're going to just get whacked on both ends. Mm-hmm. And that to me is not really worth it. Now that vol is coming in especially, I really would not want to sell any calls here. Mm-hmm. Period. End of story. If I'm looking to do this, I'd rather just sell puts. If vol does come in and gold prices ease back, then you get the double side of that as well. But seeing a 1987 down to 1887 move in gold is unlikely. But seeing a 1987 to say 2087 move in the span of a few days, that's certainly feasible. Gold and gold vol behave differently than say equity prices and equity market fall, which is worth noting.
Mm-hmm. That's right. No,
that's kind of the story for me there.
I agree with all of that. I think the idea that gold has a higher floor on it makes a lot of sense, because as we go into, and this is a longer term sort of assessment, as we go into a more chaotic, less globalized, less U.S. policed world, these geopolitical flare-ups are going to happen more often. And so there's going to be a kind of level of we need to have gold generally higher. The floor on it needs to be higher just because there's more of a risk premium writ large over the next however many years. But this current episode may have already been benchmarked. Yeah.
And we've spilled enough ink or enough airtime talking about what's happening between Israel and Hamas. Mm-hmm. I just got to say, I don't see anyone talking about Pakistan displacing 1.7 million Afghan refugees over the span of the last few weeks. I don't see anyone complaining about the 7 million people in Congo that are currently deemed to be refugees because of the infighting and war that's going on there.
Turkey? What about all the Syrians in southeastern Turkey? I mean, the list goes on. It's always...
None of whom conducted an atrociously disgusting terrorist attack.
I'm just saying, the world gets fixated on certain geopolitical issues and then forgets about them and then ignores them. Who's talking about the Russian war in Ukraine right now?
The Russian war in Ukraine ended COVID. Not COVID didn't.
Apparently.
The vaccine didn't end COVID. PPE didn't end COVID. The Russian invasion of Ukraine ended COVID. And the Israeli-Hamas conflict, war, ended the Russia-Ukraine conflict. In terms of the narrative, in terms of oxygen.
In terms of what markets care about on any given moment, or at least what the news cycle cares about at any given moment. And the crazy thing is, as loud as all of this looks now, people are running around, waving flags, saying, frankly, incomprehensible things in public and in media that you'd think wouldn't be said in this year, 2023, you'd think we'd have learned by now.
Well, as to quote Seinfeld, things that you wouldn't say in polite society, things that you wouldn't say in impolite society.
That's right. That's right. All of the sort of awfulness that you would think has been permanently relegated to live under a rock has climbed out of it on this occasion. But it did this also when the Iraq war broke out, when the Afghanistan war broke out. And then it just kind of died because people lost interest and moved on to whatever the next thing is.
One thing that is definitely suffering, despite the prevailing narrative and media focal point right now, what's happening with oil, guys? Oil looks like absolute crud.
I think oil is aligned with a slowing growth story, not a rising conflict story. Very simple.
I absolutely agree. And that may mean that perhaps there's a little bit of a higher floor here in oil prices. But if you're trading around these geopolitical events, you would think that the specter of Iran getting involved, the closing of the Strait of Hormuz is always a lingering threat out there whenever they start, throwing rocks and sticks across the borders.
Again, back to the beginning,
The market does not, exactly. The market is telling you right now that there has to be a serious, significant escalation. Oil may be trading even lower, have it not been for what happened about a month ago between Israel and now the ongoing situation between Israel and Hamas. And so oil prices here, they just look like absolute garbage. U.S. growth is slowing. The Eurozone's in a recession. China, despite their best college efforts, they have not been able to resuscitate growth. They still have this significant property market issue. No one's talking about China's developers anymore because, again, we are just dogs chasing after an ambulance here in financial media. At least most financial pundits are. And so the narrative has been subsumed by what's obviously a great scale of human tragedy. And yet oil should be at the centerpiece of it if this was a really significant development. So the fact that oil's trading like the way it is right now, got to be warned, got to be thinking that this is a market that could fall apart. There are a significant amount of longs in the market.
Oil says conflict is contained, growth is slowing. Call me tomorrow.
Well, I'm with you 100%, Dylan.
And the conversation, absolutely.
I almost disagree with it because I feel more emotional concern about the conflict than the oil market reflects, but I believe the oil market is much more likely correct.
Well, and this is very much a part of our story about gold. If oil is doing this, then gold is probably done.
Right.
Right. That's exactly how I feel about it. But vol here is still very, very high. We've closed the gap from that weekend coming out of the October 7th, October 8th weekend. On October 6th, we closed at 81.28. Here we are in CLZ3, $80.44. If you go down to a 4-hour time frame, you could absolutely make the case that this is a left shoulder head, right shoulder. It's not at the absolute highs, so that's not technically how we describe it. But you begin to look at that October 6th low right around $80, and the floor could fall out here very, very soon. Perhaps the play here, and I'm not doing this right now. As I've said, while I have stronger technical feelings, I'm not quite ready yet to jump into selling oil. Anton has pointed out that there is call skew in oil.
Yeah, okay. Sorry, go ahead.
But maybe it is one of those situations where you think about this on the put side right now, because
Straight up, you're saying.
Just straight up. I mean, XLE looks horrible. XOP looks horrible right now. These are not good looking charts, no matter how you slice it. We're sitting back near the swing lows that we had at the beginning of the month. XOP is doing a little bit better, but if you want to talk about the refiners here, CRAK, which is the refiners ETF, crack spreads have been really low recently. I know there's diesel shortages in the Northeast, but none of these charts look all that appealing right now in the very short term, despite what should have been a better backdrop, given what's going on globally speaking. And
what about
it makes you wonder.
I know we're running the clock here, but what about the last 30 seconds on the crypto run? Even just in the past moment here, the past hour, 2 hours, Bitcoin, even Ethereum's got a little something going.
These still look good. And what's to say?
The Fed certainly doesn't hurt here. I mean, they didn't.
You like Ethereum as much as do you see a difference between Bitcoin and the rest, or is it all the same pile of assets?
One ring to rule them all is kind of my shtick here with Bitcoin, and Bitcoin is going to come out as the clear winner. Ethereum has been a mess since they, moved away. They shipped protocols. I think it was last year. Underperformed Bitcoin significantly. The technical setup here in Bitcoin is much better looking. If anyone's going to adopt anything on an institutional level, it's going to be the one that was here the longest, plain and simple. I don't know what else there's to say. And if tech stocks start rallying and people are shifting out on the risk spectrum, crypto is going to be back in vogue. And by the way, the only thing that's like close to outperforming crypto this year are orange juice futures, for what it's worth. Bitcoin's up over 100% year to date.
Completely.
That's always entertaining. Was it you that was sending around the old trading places pieces?
Yeah. That's so I used to ask when I would hire on my team. One of my favorite questions was, "What's your favorite finance movie?" Because when somebody answers that question, you kind of get a sense for who you're talking to, and if you're talking to a real trader type. So if people said something like, let's say Margin Call, or they said Boiler Room, or they said Wolf of Wall Street, or something like this, especially if they said something like Margin Call, that would be encouraging. One guy I hired on the spot said Ghost. And I said, well, what? Why Ghost? And he said, well, wasn't Patrick Swayze a frozen OJ futures trader in that movie? And I'm like, the fact that that's what you got from Ghost means you belong here.
I think that's as good of a turning point to say that overtime is now out of time for this Wednesday, November 1st. He's been Dylan Radigan at Dylan Radigan on X. Ilya is at Ilya Spivak on the website formerly known as Twitter. You can find me there as well at CVecchioFX. Until next time, good luck trading macro money with Ilya Spivak. Up next, stay tuned here on Tasty Live.
See you there, everybody.